Hello everyone, welcome back. This video, we continue with our Accounting 210 chapter 11. And then finally, I think we are talking about the last item, right? Fixed manufacturing overhead variance. So this one is a little bit different from what we did for the variable cost, like direct labor, direct material, and then variable manufacturing overhead, because it's a fixed overhead. So it's a little bit different. I don't know. I think it's easier actually, because all you need to know is you have the actual. You don't need to calculate. Most likely it will tell you your actual, and then this is your budgeted fixed manufacturing overhead. So it's your actual and your budgeted, and then you also have your standard fixed manufacturing overhead cost allowed to production. Okay, so the question, let's look at this one, and then we will do a practice in the next video. Don't worry too much. So this one told us, it said the actual is already told you is you expected to do this, your actual is $31,025, and then you expected to incur 30,000. So this is your budgeted. This is your budgeted will be 30,000. And then we also have the standard. How do we get the standard? Remember, we go back to the first page, right? We looked at our menu. The standard said we actually produced 31,000 units. Each one based on the standard fixed manufacturing overhead is we allocate 0.1 machine hour, and the rate is $9. Okay, so we just put that. The total amount will be 31,000 units. Each one is 0.1 hour, and then each hour we allocate $9. So if you do all the math, this is already told you, So if you do the math, this is 27,900. And then the difference of actual and budget, we call it a budget variance. We call it a budget variance. It's $1,025 unfavorable. Your actual is more than the budget. The difference between our budget and the standard cost allowed, we call it a volume variance. And then this one is $2,100 unfavorable. Okay, so the interpretation is a little bit hard to say actually. For the budget variance, basically it's just to compare your actual with your budget. So that means you didn't budget enough, so you have unfavorable, or your actual is just simply more than the budget. That's it. I do not expect you to know too much. Just make sure you read this paragraph by yourself, get some idea, that's it. And then for the fixed overhead volume variance, you need to know this part. Okay, I kind of used the board words. So why we call it a volume variance and why it's unfavorable? General idea is when production volume is higher than the anticipated, the fixed overhead volume variance will be favorable. So you used the same amount of the fixed manufacturing overhead and you produced more volume, you produced more units, then that variance will be favorable. Let's say, hey, you used $10,000 fixed manufacturing overhead. You thought you will produce 2,000 units, but you produced 3,000 units. Then you will expect to see favorable fixed manufacturing overhead variance. But for the other side, if for the $10,000 fixed manufacturing overhead, you thought you will produce 20,000 units, you only produced 15,000 units, the volume is lower, then in this case, you will expect to see unfavorable fixed manufacturing overhead volume variance. Okay. That's it. So how do we interpret this unfavorable volume variance? You just need to interpret that your actual volume production is less than your budgeted volume, than your anticipated volume. given the same amount of fixed manufacturing overhead. So I'm being honest, when I read this question, I thought, hey, it doesn't make sense because, you know, we thought we will budgeted to produce 29,000 units, but actually we produced 31,000 units. So I said, how can it be unfavorable? Because your actual, if you look at this, 31,000 units is more than your master budget, 29,000 units. I don't want to misguide you. That was my concern. I look at the textbook, then I found out this is just your monthly, this is just your January. So if you are curious with my question, I would say go back to a textbook. The textbook said for the yearly volume, your actual yearly volume is lower than your yearly participated volume. So that's why you have an unfavorable volume variance. But as I say, I don't want to misguide you. So just to make sure, kind of remember this paragraph. Okay, I think I will talk one simple, very similar question in the next video. So basically, we are almost done with this chapter. Okay, we are almost done with this chapter. Let me know if you have any question. I'll see you in the next video.